Here's what's coming up on today's show.
But the money I'm going to need in a little while, in the short term, I don't need to take any risk there. So that's kind of like door number one, bucket number one. I'm going to put that in things that don't go boom because I'm going to be using that for cash flow.
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
Well, let's talk about the markets, guys. So Josh Brown, a CNBC commentator, usually has some wise things to say about how you should react during difficult times in the market. He says that when you're dealing with a difficult stock market, the answer is rarely try harder. Instead, the answer is usually do less. So I guess my first question is, do you kind of agree with that sentiment, Craig?
Yeah, I kind of do. It depends on the market. You know, is it a dramatic problem or is it just like right now, everybody's all flustered and I'm like, it's not down very much. I mean, it's not doing very much. It's just volatility. People are trying to figure out what Donald Trump's going to do, you know, every day. It's kind of comical to me. But yeah, the more you touch it, the worse it gets most of the time.
Yeah. People are trying to control it, right? People want to be in control of something. And so when things like this happen, they're like, what can I do? How can I control it? Well, I can pull my money, or I could change my investments, or I can do something.
Yeah, that's a great point. Type A people typically do have a tough time. I'm one of those dealing with the concept of don't touch it, right? Sometimes you think, no, I must touch it. I must fix it. I must put my hands on it, right?
That's right.
But it's not always the best thing. So let's break it down a little bit. So how am I taking the right types of risk? Is that maybe the best question to start with?
Yeah.
Okay. How do you know?
So when I first started in this industry, I'll give you my why. It'd be a funny story if I had the time to tell you how I was recruited, but I ended up at Smith Barney, Harris Upham, good firm, but it was a stockbroker firm. And I would talk to people, you know, and so I had my three favorite stocks. I had my municipal bonds. At that time, interest rates were very high. And I was talking about product, and I really couldn't put my finger on how to do this for people. Once I became a certified financial planner, it's like, oh, magic, you know, because now I invest money towards a goal rather than just let's buy something good and hope it goes up, you know, that type of thing. So, you know, the right type of risk is dependent on a lot of things. For example, how old are you? If you're young, you know, you don't need the money. You're systematically saving towards your long-term retirement goal. When things go volatile to the downside, man, you should add to that because you have time, you know. The question is, how long before you will need to use this money? So if it's a retirement nest egg and you are going to have some of it for cash flow, let's do a scenario, okay? Let's say you're 60 and you're going to retire in 5 years. You're going to be 65 to make it simple, and you need to keep net after taxes with an inflation adjustment about $10,000 a month. That's $120,000 a year. It's a decent life. Okay, you take your Social Security and you say, okay, I'm going to turn it on at 67. So 2 years later, you're getting, in my scenario, $50,000 a year. So you're going to need $70,000 a year. You can divide it by 12 if you want to take it monthly to live on, you know, after taxes. So now, ask me that question again. What type of risk should you be taking? And it's different. Gotcha. Okay, than if it were Cameron, our son, who's 31 and doesn't need this money for 34 more years, that type of thing. So investment returns are usually quoted as averages. So if you look at your 401k statement, it says how much we did 1, 3, 5, and 10 years if it has a 10-year number. And you should think of that as a batting average. Let's give somebody something to think about here. If I had $100,000 and I'm up 20, I have $120,000.
Right.
And then if I lose 20, I don't lose $20,000. I take 12. I lose 24,000. So I'm actually worse off. I'm at 96,000 now. You've got to be careful with the volatility for the money you need now.
That's why it's really difficult for people to look at percentages and think, oh, okay, over time I should be at a 7 or a 10 or a 20 because the average percentage return is a certain amount, but you're not. You need to look at the dollars impacted.
Right. I remember we sort of topped out December of 2021. It was like 4,800 or something, and the market went down as much as in 2022 27%. So in October, it was down 27%. It ended up down about 18 or 19% because it came up some right at the end of the year. But I mean, if you stop and look at it from January, January the 1st of 2022, December of 21, until about the 24th or so of January 2024, those two mountain peaks were the same place. We didn't make any upside from there, although if you measured from January to December, we did.
Right. And that's the real tell.
You got to get a little macro sometimes versus micro on those. Just while we're chatting, I just kind of S&P 500 Googling. If you look at 6 months on that, Craig, it's down about 3%. If you hit the 1 year outlook, 1 calendar year, it's up 9%. If you hit 5 years, it's up 95%. In 5 years, right?
It's crazy.
Yeah.
So the volatility part of it is the problem. So
right.
How do I do this? Am I taking too much risk? Am I not? Again, it depends on where you're at, but consider taking a set amount of money each month out of an investment account that fluctuates. In some cases, I'll take October of 2022. We were down 27%. If you needed to use the money, volatility is not your best friend. It's not your buddy. So you should set aside and put your portfolio where you do not, the money you're going to need right now, you should not put it at risk. It's just simply said. If you're going to need money in the next few years, and that's 1 or 2 or 3 years, money markets, T-bills, a laddered bond portfolio that actually matures, not tech stocks, because that's gambling and you're going to use this money. What if you lose? I mean, if you look at the worst sectors in 2025 right now, IT is down about 11.8%. Discretionary is down 13-some%. Communications down 5.8%. So if you were going to try to use that as the thing you pulled money out of, it was a bad bet. It was a gamble, and you probably would lose. But you've got to think about how you're going to set this thing up. You also, on the other side of this, if you don't need money for the next, and I'm not saying that these are separate. I'm just saying that you have some money placed for the things you're going to need now and other dollars that you may not need for 5 to 7 years. That certainly should not be in the CD at the bank. Well, I want to be safe. You're not going to have any growth. So 5 to 7 years gives you time to grow. Invest in things that can appreciate. Real estate, growth stocks, and look at what's happening around you. Much money, especially in North Carolina, but other states, is being spent on things. The broad term is infrastructure. Mm-hmm. But it's not just roads and bridges. It's power generation, data storage. There's a lot being done here for nuclear power plants. So you're thinking of the big thing like Lake Norman. They're making these modular nuclear plants, and they're actually retrofitting coal-fired generation plants, that have been idled, for years. So there is a lot happening here, and you have to ask yourself, where's the growth at? And that's where you should put your long-term money at. Am I going to see something happen, maybe not this year or next year, but maybe 4 or 5 years from now? This is where the ball will be if you're a golfer, and so you have to think about it. I look at other stuff, and, people say, we're in a bear market, and I'm like, God, I don't see it. Now I'm using data from 425, so bear with me. The S&P is down 5.7%. That's not a bear market. That's not even a correction. The Dow Jones down 5.2. NASDAQ right at 10, so maybe we call that a correction, but 9.8%. But at the end of the day, we're not seeing anything other than volatility. We're not having market declines that exceed the normal parameters of a stock market anyway.
Which is really kind of, Craig, we're not what we're hearing from the major media stations, where they're trying to kind of drum up some frenzy and some negativity, I guess, and panic of the investor. And we are just much more calm about the current status of the volatility in the market, as it's to be expected. There is going to be volatility, and it's not that dramatic, really, in the scheme of things.
In January, just to put all this in perspective, the major indexes of the U.S., the S&P and the NASDAQ, I'll use those two, were at the highest points they have ever been, ever. And so trees don't grow to heaven. That was something somebody taught me a long time ago. You will see corrections in the market. Things will revert back to the averages or the means kind of overvalued.
So, guys, we're talking about the difficult markets. I guess the big question people have, Craig, often is if this bear market, and I know you said earlier, technically it's kind of not totally really a bear market, but depending on how you're measuring it, if this downturn, for lack of a better term then, continues all year, let's say all of 25, is that a knockout punch for my portfolio? That's what people are worried about.
So how would you react if you had a portfolio, say $1 million, and it was down 20%? Now, percent doesn't sound bad, but if I came to you and said, good news, we only lost $200,000 of your money,
right,
and you hang in there and it's going to come back, how do you feel?
I'm not happy.
Seriously.
I'm not happy.
I mean, when it's dollars, it's
It gets
funny.
real quick.
Yeah. So much like 2008, what if the market continues to be down? Most portfolios, I'll just use the S&P, the stock market continued down for about 495 days from October of 07 to about, January of 09. General range down about 50-ish%. So how will your portfolio do in an environment like that? What you would probably react to it, but would it be a reaction that's too late? Did you have something that was anticipatory? Or were you somebody that had a strategy in mind, a method to say, at a certain point, I know where I'm going to exit. At a certain point, I know where I'm going to re-enter and have a real strategy in mind. So,
and not only that, Craig, do you have a strategy of where your near-term money is going to come from, and you've taken it off of the volatility of the market and really created that income plan?
Right.
I mean, that's
I agree
really,
wholeheartedly.
yeah.
For those of you that are close to retirement, think about this. If you have it the way you invested 10 or 15 years ago, and we have more downside. I don't know that we are. I'm not trying to make you feel afraid. I'm just saying that you need to take a good hard look at how you're going to set this up. We talk about bucketing strategies quite a bit, but the money I'm going to need in a little while, in short term, I don't need to take any risk there. So that's kind of like door number one, bucket number one. I'm going to put that in things that don't go boom because I'm going to be using that for cash flow. Door number three, I'm going to jump on the other side. I need that out there for growth. I do, because, if I live a long time, I don't want my money to be at such a low rate of return that I can't really keep up with inflation and taxes. And in the middle, you need an income generator. You need something that's generating interest, dividends. You need rental income. You need things that generate real revenue, not maybe go up, maybe go down, but pay you money.
Cash flow.
Yeah, that will be there to fill in for what you're spending out of bucket number one. So a strategy is much more important. Now, if you want to know what your portfolio today would look like, we can run this back to October of 07, which is a good time to take a look at it and provide what we call a sensitivity analysis to show you your best and worst for your actual portfolio. It's worth a look to take
best
a look at.
Best and worst. Let's explain it a little bit better for the listeners. Best and worst case of their portfolio, right? Market volatility, how it would grow or how it would react on the negative side.
As we go and look at things, what we try to do is make sure that you understand how this reacts over different windows of time. So we can look at a long period of time. What's your batting average? What's your worst drawdown? How bad did it do in its worst time? We can look at its average volatility, and we can talk to you about that and say, here's what this thing looks like long term, the last 5 years, the last 3 years. It'll give you a look at how you're going to have volatility in real time using history.
I think that's important for people too. So when it does happen to you and you're looking at it, you've had a chance to think about it and know that, yes, I can weather this, or I can't, or maybe I should solve for this because I'm not going to be able to stay the course. Most people run into problems, Craig, because they're not following the plan that they had initially, if they had a plan, they're not following that plan because they get a little emotional and they fearful because they don't really trust that plan. They haven't tested it. They haven't looked at the volatility and what could happen and making sure that they can weather those storms.
All right, so those are the portfolio type things that we would want to talk to you about. Think about your income when you quit working. It's an important thing to consider. So you work to, and I use 65 as an average. It doesn't matter what age it is. And you say, okay, I have some cash flow coming in. I have 2 Social Security checks. When do I turn those things on? As soon as I retire? Or do I look at the pile of money that I have and say, I can take 1 or 2 or 3 years out of, say, my IRAs or 401ks, pay my lifestyle for those 2 or 3 years, and then get the best check I can get out of my Social Security. Okay. And then that versus what you want. So let's say that in my example, your Social Security checks were $50,000 and you wanted another 70. Where is that going to come from? Do we want to guarantee some of that? Do you want that 70 to be in things that pay interest and hopefully some growth? Do you want to guarantee a cash flow using an annuity? How do you want to do that? So those are things that as we build an income plan around your particular needs, we're looking at it and saying, here are the options that you have. If we use this, this is the outcome. If we do this, this is, maybe probably what will happen, if we're just purely using investments. And now you start to think about how much control do I want to have over that cash flow in my future? So again, all of this is part of the planning and strategies that we work with you on as we're building out, your financial plan for the rest of your retirement years.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax affiliated insurance agency.